Joining us on the phone to talk about the markets is Dan Zwicker of ADM Grain Group. He's in Decatur, Illinois. Good morning, Dan.
Good morning, Dave.
I continue to monitor the U.S. dollar. As you say, it's certainly one of the hedge pins that we've been keeping our eye on of late. That projected up flag that we saw technically last week has come to pass. In last few sessions, the dollar has rallied significantly, made new highs for the move, banged up against its 200-day moving average. And technically, where do you think we go from here and why?
I think we're going to the low 80s. That would be my initial reaction, just glancing at the chart. Basically, what that is adding the first leg advance of 428. That was off of the November low into that Christmas high of 78.45, and you add that 428 to the bottom of last week's corrective low of 76.60, and you got a target about 80.88. So that would be what I'm looking at. But we do have a major hurdle to cross here today or tomorrow, and that is that 200-day moving average. We're right up against it here today, and whether or not the market has enough muscle to plow right on through there and have some follow-through buying interest, that's going to be the key to watch. But all technical action is favorable toward the market doing that. I also look at the 50-day moving average is crossing over or above the 100-day moving average. So anyone that follows these long-term moving average systems for trend changes and trade positioning are going to be, or they're going to want to be buyers of the dollar.
How many days or trading sessions would you give for the dollar to get this 200-day moving average done?
Well, there's no hard and fast rule, but a lot of technicians like to see consecutive closes above these critical points, whether they're resistance or support points, and in this case would be a moving average. I think you'd want to see consecutive closes above that 200-day moving average, and I think that would, take it another step down the road to validating that we are on our second leg to the upside that's headed into the low 80s.
Let's turn our attention then to March corn. And we had wanted to see within a few sessions this gap that was left over from the USD report last week filled. It has not been filled. I guess that means it does indeed become a measuring gap at this point in time.
Well, there's nothing hard and fast in any of these technicals rules that I express over the air from time to time, but it is still a measuring gap potential. There's no confirmation one way or the other. The only thing you can really say is that if it is a measuring gap, then that projects a downside price objective of 353. But you can quickly go to the bottom end of the momentum indicators, and you can kind of see we're in this oversold category. So we are ripe for a period of stabilization, if not maybe a little short covering bounce of some kind. As a technician, I would watch that pretty careful here today or tomorrow, because if the corn market was able to muster a decent short covering rally, it wouldn't take much to maybe close out the week higher, and I think that would be somewhat supportive toward the idea that maybe the market is trying to trace out some kind of winter low point. But for now, all of the technicals that you look at, moving averages and whatnot, still favor the downside.
And then as we look at the soybean charts, we were looking last week at continuation charts and wondering whether or not we were in a consolidation phase or not. And in the days since, we drifted a little bit lower. What are you reading now?
Well, I'm looking here at the March futures, and basically I think last week was what I would term as a bear flag formation, because we did break below that here on Tuesday. We had good downside follow-through activity here yesterday. Now today we're a little higher, but we're kind of in an inside range type, so to speak, and that does project, a longer-term target, maybe down into that 890 level, give or take a dime or so. But as I mentioned in corn, if you look at the bottom of the chart, you can see the momentum indicators in very oversold technical conditions, and probably ripe for the market to consolidate and or have a short covering bounce of some kind to maybe work off some of those oversold technical conditions. Now, it's always, my observation is that since we had such a hard down basically here in January, during the middle 10 days of January, my guess is that next week here is the last week of the month. We will probably see some form of short covering rally or a period of stabilization before a month's out. That is very common. I mean, the last week of each month has a tendency to go opposite of what the dominant trend of the month has been. In both corn and soybeans, we are down for the month. So you have a tendency for traders to kind of want to take profits before the end of the month and pay their taxes.
Thank you much, Dan.
Very well.
Dan Zwicker of ADM Grain Group. He is in Decatur, Illinois.